And with this oil spill, normally an oil spill is bullish because regulations cut down on the prospective drilling of new oil. But this seems to be becoming a bearish thing to our already kind of psychologically depressed market. Is this, how are you reading it there, Brian?
Well, Bill, you know, this oil spill, as a human being living on this planet, I hate thinking about it. Right now, nothing in life pisses me off more almost, but looking at how it's affecting the market, you know, it does have people talking that we're going to have potentially more regulation on both exploration and drilling. The U.S. government's already declared a ban on offshore drilling, which, you know, we had approved that just shortly before this happened, and they're going to be restricting new permits for 6 months. So at this point, that will provide somewhat of a underlying fundamental support at some price. I don't think it's here. But looking at how we've traded just in the past month, as you can see, basically this thick blue line here is the uptrend from the July lows of last year. And after having this 3 weeks of sharply down momentum based off of what was happening in Europe, we failed at 38% retracement on last week's recovery rally. So with the 20-day moving average right here, with the old uptrend right here, we like to be a seller just under $75 a barrel, maybe 74, 75, 74.50, somewhere in that area, risking above 38% retracement. Now, we do feel that if we can push through that 20-day and through 38% retracement, then $80 may be a likely target. So we'd like to be a seller before 80, but you want to notice that your 100-day, your 50-day, and your 200-day moving averages all seem to be converging just in that $80 area right now. So that may act like a magnet if we can take out last week's highs. But I'm still leaning on the sell side. We had China's Purchasing Managers Index. Their PMI showed factories scaled back production and slowed hiring. The Eurozone PMI also showed less activity in May versus April. And from a big picture perspective, the equities, assuming that we do not take out last week's highs this week, we're going to have 5 weeks in a row of thing that you want to look for in a market that should be recovering. So I'm going to lean on the sell side here. I think rallies are still selling opportunities with what's going on globally and what's happening with Europe. And also, the dollar is still in an uptrend. This is the market that's been trending higher since the beginning of 2010. And I could see that short term we could possibly be building a sideways range. If that's the case, just like we failed at recent highs on the overnight trade, you can look to sell it at the upper end of the range. Now, being that we are in an uptrend, I'd keep a tight stop on it and keep a pretty low risk on that trade. I'm more inclined to buy dips. So buying at the lower end of this range, I think, is advisable. And also looking at the uptrend here that we've been in really since early April as support.